Hey, and welcome to TSOB. This is a podcast for entrepreneurs who are interested in investing or starting their own funds. We are Adam Anderson and Zach Eikenberry. Join us to get a behind-the-scenes look at the relationships between founding entrepreneurs and the VCs that invest in them. Hey, Zach. It's exciting to have you here. You're actually in my upstairs office, my wife's office. What brings you to Greenville, South Carolina today?
I'm going to do some company meetings. I'm going to be in Greenville here for some company meetings, one-on-ones.
That's staying in. That's totally staying in the podcast. Yeah.
Hey,
shit. So you're here for some company meetings. Shit.
Yeah.
Is that what it's like traveling for your startup? Is like, oh, I gotta spend that money, fly up, and stupid people.
It's end of the quarter, moving into Q3, trying to rally the troops. So all those things. That's what it is. Well, it's not so much rally the troops. It's overdue. I haven't been here since end of April, 1st of May.
Right.
And so.
Yeah. Well, it's interesting because I don't folks know this. You are running a cybersecurity startup that is 3 years old, and you have a distributed workforce where not everyone shows up to the same office. And we can dive into that. But I had a couple topics I wanted to talk about. Again, what we're trying to do here is give a window to the listener of the behind the scenes of the full contact sport, which is venture capital and startups. And I figured we were just going to go through and talk about, like right now, I'm trying to decide, do I take chips off the table or not? And you're trying to decide, how do I handle an oversubscription? What's my strategy for, dilution? And I figure let's talk about that today. And if there's time, I'd like to dig a little bit more into, hey, what's it like running a remote team when you're in the middle of all this, and how do you communicate to the team about the raise and about all of those kind of things? So, to jive with you, did you have anything you wanted to chat about today?
No, I assume that's what we're going to be chatting about. So let's dive in.
It's really easy to do this when all you do is talk about what's actually happening to you. It's kind of like this is the perfect podcast, and two really, really, really smart people came up with the concept, and then we stole it from them.
Yeah, exactly. Enough about me. What do you think about me?
Well, I do think a lot about you, but I've been told that there's a restraining order and I can't actually say all those things anymore. Something about slander and liable and blah, blah, blah. But hey, let's do this.
That's fine.
Let's get into it. You tell the listeners where you are currently at with your raise with the company. And it's just like two to 3 minutes. Boom, boom, boom.
Yeah. So set out to raise a bridge prior to Series A because we knew we needed a little more capital to grow, to hit some metrics, primarily revenue, before our Series A. And we did that. We raised a little bit of venture debt. And we met with another founder who had recently exited, and he fell in love with our company. And as founder does,
right? Kind of hard.
That's right. He immediately came in. As a matter of fact, he's the CEO of a recent unicorn, and he wired us the money before he signed the docs.
Sometimes it happens that way, right?
Yeah, it's happened twice actually. So
maybe this venture stuff is just lies, and the right answer is hang out with more high net worth people and be delightful.
There you go. And so we raised that round, and now we have additional people that want to come in because they're friends with the founders who just exited, who put in.
Yeah.
And so all of those dominoes are coming together at once. So we're oversubscribed for our original target, which was like 600,000. We're like 600,000 for equity, maybe, 300K for venture debt. We ended up getting 500K venture debt. And now we're looking at confirmed 650 in. And we have an interesting development with an institution that's local who wants to jump in on the bridge as well for up to $500,000, but we don't know where we stand right now with them. So
theoretically,
that's our story.
you were raising $600K in bridge, and you've secured $500K in venture debt. And I'm going to want you to explain venture debt in just a second. And then another 650 from the domino effect of following on. And then another institutional investor wants to participate up to 500K. And so your target was 600K, and it looks like you're close to 1.7. Did I do that math right?
Yeah, 1.6. Yeah, right there.
Yep.
Yeah. So we're, yes, that's exactly right. And we are still raising the A. So regardless of whether or not this last 500 comes in or not, we're going to declare victory, and we are going to move immediately into raising our Series A. Simply because with the market conditions and a few other things that I believe are holding true for the larger macroeconomic, not for our business. I think our business is actually pretty resilient in a good spot going into any sort of downturn in June 2022 and beyond. I do believe we need capital. I do believe we need capital to weather the storm. I do believe that we can come out the other side of this if we are efficient and effective with our cash burn, and we position ourselves correctly for the next 2 years. While it's tough out there for startups to get going, I believe we will do incredibly well in the marketplace, and we'll come out with outsized valuation and upside. So what we're attempting to do is I got to figure out what we need to do with this bridge right now, and I might just take the dilution, namely because the terms were great 2 months ago when I handed it to them. Now the terms are awful when it comes to this 500K, this last bit. But it might be worth it just so that they can participate in the A and we can continue on. So those are some of the things we're talking about. I will say, if I can, yesterday was an investment committee meeting, right? And I don't have anything, I'm pretty neutral on the overall process that venture capital will go through, where they say, hey, you need to talk to the whole committee at once. It seems antiquated to do so. There's not information that comes up in that context that's helpful. And it's a bunch of folks processing their emotions and feelings through a deal, which is fine to bring your intuition to the game. But the group think is just, I don't understand why it shifts one way or the other. Well, and so, here's my point. My point is, as a founder presenting to these investment committees, I've done this a handful of times now, no investment committee has actually read the deck or the financials prior to the meeting. They all show up hot. They all show up thinking that they're the shit when it comes to picking and choosing founders and companies. And they make you pitch from scratch. All of them have. All of them interrupt you in the middle of your pitch like it's the Supreme Court. And you just got to start making your arguments. And you're constantly referring to financials and other due diligence information you've already provided to them. And it doesn't matter that you did that. You can spend hours and hours doing it. It was all theater, because at the end of the day, it's these 9 folks in a room who are arguing with each other to like get in some sort of group think and all go in one direction. And that's what these investment committees are.
So the people on the investment committees, were they the general partners of the fund? Who was in the room?
Yep. General partners of the fund, a couple of LPs. In this case, they brought in some sort of former executive from a competitor to talk, and they have their own point of view, and it's not helpful for me because they're very defensive about their previous employer and all the smart decisions they made. So that's completely unhelpful to bring in an industry expert at that level. Bring them in the due diligence, and in the meantime, bringing in industry experts into your investment committee, not helpful. That's amateur.
So it paints a picture of a process that doesn't work. So if you are having to start from scratch and they don't come with questions, then all of the due diligence and all the stuff was really there to make sure that the juniors were doing the work where the GPs knew whatever they sat in front of was at least a quality company. And it is not a entrepreneur friendly experience. What it is a so as a VC, like on my side, I've got LPs I got to worry about. I got other general partners, and we all share political capital with each other. I have a vested interest in making sure the other general partners are bought into whatever deal I bring in, because I want to be brought into the deals that they bring in as well. And so there's a lot of horse trading. Hey, come on, sit on my board. I'll go sit on your board. Hey, LP, thanks for putting that money in. I want to bring you in. And that small little pool of political horse trading is, I think, what you just experienced. Now, the problem is that when that becomes what the organization is, you could be gone. There's no limit to great deals as far as they're concerned. And so the care and feeding and the quality of life of the entrepreneur becomes secondary to the relationships inside of that very small ecosystem. And so it seems to me like that experience, which, by the way, no one ever draws that up on the whiteboard. This is how I want it to work. I want us all to be cool, and let's crap all over the entrepreneur and wreck their soul. And if they do, then they actually turn around and say, well, that's good, because we need to find out how this entrepreneur does under stress. So let's stress test them. I'm like, sure. That's dumb. So now I'm trying to discover what I'm talking about here isn't saying, hey, that's okay. What I'm saying is, if you're a VC and you're listening to this, if you're a managing general partner, there are ways to build that political capital and that rapport in different ways than having to do that in front of the entrepreneur. Handle your
or with my time. Like that's
exactly.
The issue.
Exactly.
Either allow me to invest the 5 or 6 hours to get you all the materials, work through them, stress about word choice and graph placement and how I'm putting this together, or tell me to prepare it for just open arguments at the Supreme Court. Like, I don't know what you want to talk about, but come prepared for everything. Pick a lane. But if you ask me to do both, to write all these briefs that you're never going to read, and then I show up and have to argue in front of the court, Supreme Court's on my mind for some reason right now.
I don't understand. That's weird.
Yeah, weird. Yeah. And if I have to show up and do both, then perhaps tell me that I'm doing both, right? But it is very frustrating to the entrepreneur who is sitting there saying they're getting mixed signals throughout the entire presentation, because some GPs in the room, because they're horse trading, are doing compliments and saying, I love your model. I want to affirm that you're doing the right thing. And others are saying, no, you need to totally pivot into this other market that I'm familiar with.
Yeah.
And so you end up with this really odd dynamic that just frustrates the entrepreneur, because all I want to know is where I stand, because it's vulnerable to ask for money. It's panhandling. It feels like I'm out there. If I didn't need to ask them, I wouldn't. But I feel the need for my team, for the company, for the other investors, etc., to stand in front of them and just, be vulnerable and shamed about all the things we are and we're not.
Well, and in the middle of all that, you're now facing dilution, where you're going up there and the very people who just gave you a negative experience are wanting to knock you out the box. Now, they're not thinking this. They're not processing the dilution side of it. They just want to put money in, and they want to see the terms, and they want to be able to deliver outsized returns to their investors. But you're now sitting here saying, these people put me through the ringer. I am oversubscribed. If I take their money, and I want their money because of what I'm trying to build, I am going to dilute myself and my co-founders and my previous investors. It's, VCs, capital allocators out there. How you show up matters, because you're going to lose the best deals, because people are going to say no to you. People are going to say, I don't like that experience at all. I'm going to go with somebody else. And the only people who are going to say yes are the people who can't afford to say no. And that's not how you build a successful portfolio. Damn, that's a mic drop. We should be recording this crap. That was some good stuff right there, baby. What? I mean, does that resonate with you?
That absolutely resonates with me. And it triggers this idea in my head, which is, one of my milestones, one of my keystones to a foundation of a good VC is show up and do what you say you're going to do. You say you're going to send the email, you send the email, right? Well, there's another level above that that I'm currently experiencing, which is VCs and others asking for information, right? But no reciprocity, no response, no acknowledgement of information, no trading back, where the entrepreneur continues to just yell into the void and show up and keep talking.
Oh, dude.
Which is totally, I get it that might be the way of things, that everybody else's time is more valuable than mine. And so everybody's busy. But like, and I get that might be the nature of the game, because everybody that has capital resources has an infinite number of options to deploy those capital resources. Real estate, publicly traded, other assets, shoot, we created a whole new asset class in the last 10 years with crypto. Like, if we can just create new assets and you can put money into them, you can speculate, you can invest, you can all those things with your capital. And I'm up against all of them.
Yep.
Right. And that doesn't mean I'm important just because I showed up. But the idea that if you want to stand out as a VC, simply acknowledge the entrepreneur's presence when they send you something. Thank them for the gift of their deck. Thank them for their interest in working with you. Clarity is kindness. If you have no intention of ever working with them or getting back to them, tell them where they stand. Otherwise, acknowledge them and then move on. And so that's the other part of, even with this particular group, but others, there's a lot of just talking into the void.
Yeah.
And so when I have to think who I want on my cap table, right, I have to think, is their money worth the fact that they're only going to show up when they need something from me?
Uh-huh.
And when I need something from them, the odds are I'm going to yell into the void.
Well, another way of putting that in a much more succinct and direct way is, who's it gonna piss me off when I make them rich? Like, if I had such a negative experience and I succeed despite what they made me go through, how pissed off am I going to be to write them a check? Right? Because that's the thing, right? I mean, look, we can build any kind of company we want. We can work with whoever we want. It's a scarcity mindset, and it's a lie to say I have to work with this person or I have to do this thing, right? There's always an option, there's always a choice, and that could be hard, but you're oversubscribed right now. And I mean, how do you navigate that? Do you just take checks in order of your preference? Like, okay, I'll take these from this private investing group, and then at the end of the day, you can always tell that last group, no, thank you.
The only reason, there's two reasons for this particular opportunity to still percolate with me and to say, okay, maybe if they say they'll write a check. One, they have promised follow-on funds into Series A and beyond. Okay. That alleviates and de-risks future round raising, right?
Is that in writing or is that a verbal thing?
No, it's all verbal. It's nothing's in writing. So that might be worth the paper it's written on at this point. Nothing. But second,
it's in the blockchain, and so never mind.
Yeah. The second is I don't know what raising a Series A is going to look like in the next 3 months. Mm-hmm. There's a lot of people making remarks, comments, jokes out there about the dynamic shift with VCs. And VCs do have to shift fast. It's the nature of their game. Like, they cannot be lagging in any action. They are extreme. They accelerated valuations up because they needed deals. They needed them now. They had the capital. They had the resources. They need the portfolio logos. They moved. And then they stopped moving immediately when they also sense that they're not going to get return. They're never going to stick their neck out for an entrepreneur. And so
right. The entrepreneur is not the customer. Their investors are the customer.
That's right. And so the founder, the entrepreneur, the companies they invest in, the startups, are the product. Mm-hmm. Yep. So when it comes to that dynamic, like, I don't know if the spigot's being shut off in venture capital for everybody in such a way, and it will never go to zero. But it makes the threshold for me to get in front of folks just higher and higher and harder and harder to accomplish. So if I need to plan for a rainy day and somebody comes along and says, you want my money, I'll give you another 10 months of runway, like, I'm going to look at it.
Yeah.
And that's going to be consideration. And I'll say, oh, you're not going to meet my emotional needs by respecting my communication I sent to you. All right, I'll get over it. For 10 more months.
Yeah, and if I can jump in as chair of the board, yeah, get over it. It's a full contact sport. Let's go. Build the VC you want to be in the future. All right, well, that gets us into the topic then. It's the dilution. You are making the decision to oversubscribe on terms that are not your favorite because of the way that the economy is going. You want to get that cash and de-risk future hook. You'll then do the best you can with the Series A. Also, probably not at the best terms in the whole world. And you're going to look at, and by the way, these are market-driven numbers. They're not Zach's like, I'm going to screw over and get out. I mean, he does talk like that, but normally it's when he's talking about the latest Rick and Morty episode, which I still have never seen. I know I need to go and look at them, but I'm all about Letterkenny, so whatever. So the math that you're doing is putting the bet on the company's ability to hockey stick in another 2 years so that we can take whatever deals we get for Bridge and Series A, and then we absolutely crush all metrics and all execution and really hit the valuations that we want in B. And by the time you get to Series B, we're going to be either coming out of this or not. But I believe that the economy goes in waves, and I think it's a sine wave up and down. And I feel like this is the perfect time to hit the highest valuations on the exits and on the IPOs and on the later rounds, because the market will be rising at that point. And this is probably some of the most expensive money we will ever take, but the returns that we're going to be able to generate are going to be massive because of the way that the economic cycle is probably going to go. And these are the bets that we have to think through. So did I walk through your thought process on this accurately, or how would you riff?
Yeah, so I would riff on dilution is best compared to growth, right? So dilution is the percentage of the pie, and growth is how big the pie is. And so when you take a bigger dilution, which is you give away a percentage of your current pie more, right? So if we say, hey, so like our current pace to give away pie in our previous to Series A and then into our A is potentially 50 or 60% of the company as the current pie size, right? And that's what we mean by dilution. Dilution in that case is ringing large, where in theory you should be 15 to 20% per round. So if you're really good at it, we'd only be giving 30% away of the company on paper. This is what they tell you in the Stanford MBA classes, right? But what we're looking at is like a 50% dilution event when all is said and done. You'd say we raise the 8 million, we convert our convertible notes and safes, they all come onto the cap table. Everybody has this interesting set of preferences on their shares. We've set the ocean. Now the question is 50% of what, right? And that's when we start thinking about growth and growth multiples. Because if your multiple for your company, and let's say it's 10x, what we are going to be doing is basically saying like, hey, for every dollar in annual recurring revenue, we'll say it that way, every dollar is really $10 in valuation. So grow $1 million, 10 more million to the pie, right? And the way the entrepreneur and founder comes back from dilution is, I don't care if I'm going to make this 50% of people rich, I myself am going to get outsized returns by growing the pie so big. So where Hook sits right at that $1 million mark, for us to get to, let's say, 3 million recurring, and if we do that in a couple of years, we could probably actually command a 15x, maybe 20x. That's probably the bottom then I can tell you there's reasons for that when we talk about marks and discounts. But let's say it's 15x. Now we're a $45 million company, right, with 50% dilution. But we can now go to our Series A and perhaps start right sizing it where we only raise and dilute ourselves another 10% to get into that B round or C rounds, etc.
Yeah.
And so that's how you claw back is you claw back your dilution issues with accelerated growth. And 1x is cool, but not investable. 2x is investable and good. 3x is everybody's at your pool party and you can command your own destiny.
Which is fascinating because I've been to your pool parties and I would need at least a 3x.
I didn't like fully understand because I guess technically people call them billiards parties, but like now that I know,
I get what you did there. I showed up with my Speedo and a positive attitude, and you're like, no, bro, we're playing pool. You have to like shoot them. And I'm like, I feel it was breezy. I was bending over to break.
We had to like go back and we're like, so when you were talking about pool balls, you were talking about something different.
You were talking, I get it now, right? Sometimes.
And you're like, I always bring my cue.
Yeah. Right? Clarity is kindness. Clarity is kindness. There you go, folks. Number one lesson takeaway today is just because you hear a word and you think you know what it means, it's okay to ask questions. Always trust, but verify. So that's cool. The whole dilution thing then really is two things, because when I hear about dilution in the news or from movies or whatever, what they're like is they're going to take control of my company. And that's what the dilution is. That's horrible. Please don't take control. But dilution actually isn't just about voting rights. And it isn't about, I mean, we knew building Hook that eventually the founders would not have majority ownership. And we built structures to address that inside of how the decisions are made, who's on the board, how does the board work. We know we did that at the very beginning, knowing that by Series A, Series B, founders would not be in control. We knew we were going to have that level of dilution. But why this is a little bit more important to me right now is that the dilution is happening at a lower valuation, and it stings. It stings because part of this is also me wanting to take chips off the table. I told my wife, hey, this is what we're going to do. We're going to sell a little bit of our stocks at every single turn, and we're going to retain a lot of stocks at the end of the game. But now it's like, well, at the lower valuations with a higher level of dilution, every stock seems like super important to me right now. And the idea of taking money off the table, taking chips off the table, when I haven't even seen the hand played the rest of the way, it's interesting because there's a level of security that we are buying. We're selling our shares in the company. We're diluting ourselves in exchange for the security of the capital to build the thing that we want to build. And then as a shareholder who's an early investor, I have to make a decision of, okay, what's my faith in the fact that this thing is going to go? I don't know what's going on. Do I keep money in? Do I take money out? Where are we at the ride? And it's just, I am learning that it's very, very difficult to predict the future.
But that's the point. I was listening to somebody who said, was making, as we're going into some economic turmoil is just code for like, oops, we didn't plan this, right? So it doesn't mean that there's anything wrong with the market as it's acting right now. But when you start trying to predict pricing, that's like pricing is the coming together of supply and demand. And if both things are continually in flux, right? Then how are you going to price deals, value them, figure out what point in time, if you know what the price of gold will be in 2 years, you can, short it or, put your buy orders in, however you want to do it. Like, the price of something, you win because that's the outcome at any given day. So when we're sitting here doing this work, all we can do is bet on historical norms and say, other rational pieces you hope to come through. Like, so here's the rational piece that I rely on for valuations is, let's say we're at 3x growth rate. Well, that means that over the course of next year, let's say you gave us a 18x valuation, right? This time next year, all you are is 6x our revenues. So you went from 18x to 6x revenues in your and then eventually you valued and bought at the company less than the actual revenues coming in, right? And there's going to be a time pretty quickly where our early investors, let's say they invested in a convertible note at 5 million or 8 million, we're going to have more cash in the company than 5 or 8 million. And so they're already, everything outside of that is upside and gravy. Now they're on the ride for outsized returns.
Yeah.
And so that's where I think you can reliably predict. But what you can't predict is our 1, 2, or 3x growth.
Correct. Because there's a lot.
You as an investor have very little control on that.
Right. That's, you know, then that's why we try to build diverse portfolios. That's why we try not to put all of our eggs in one market. That's or we think we have inside baseball. We think we understand the market better, and we heavily invest in a particular sector. I really deeply believe that the work that Hook is doing, and by the way, this is how you think it through for yourself when you're looking at a portfolio company and you're thinking about putting money in, is like, what do you think the market's going to do? I believe that even in a downturn, cybersecurity is very resistant and resilient to the turmoil that you just talked about. Because what's going to happen is if you underspend, you're going to get breached, and then you're going to get, you're going to have to buy the stuff anyway. And products and services that are around that are forced upon companies, such as from a compliance point of view, where if a bad thing happens and they don't have it, the bad thing is even worse, and then they have to go buy the thing, means that this turmoil actually should accelerate. In my mind, I believe that the economic disruptions that we're seeing are going to actually accelerate the growth of certain kinds of companies. And I think that Hook Security is one of those kind of companies that's not just resilient, but it will actually thrive in this new environment. Because, well, anyway, so all the reasons why I think that is the same kind of things that every, you know, capital allocator has to think about when they're talking about the companies that they're putting in. They have to work that through inside of their head. And so when I think about how many chips do I take off the table, I have to ask myself, what's my level of confidence in my assessment of where I believe my portfolio company is heading? And
yeah, but my point is, you don't have to think about that in the terms of forever. You just have to think about that in the terms of the next 2 years.
That's correct.
At most. Really, it's 1 year. If it's a 1 year mark at 3x, you just have to reliably ask, can I make the transactions happen? Not the transformations or anything else. Can I make transactions happen that get you 3x, put your valuation in the right spot, and all your markups on paper will make you look genius because I'm the product, you have customers. You can then go to customers with markups on paper and get more capital.
Yeah, no, it's amazing. And this is what I love about investing in the bridge round. That's what I love about the bridge, because if someone is going to be successful raising money in the bridge, they have to prove that the system is actually working. And you also get the valuations that are more friendly than a Series A would be to an investor. And I absolutely love it because you can, if you deploy into a bridge and then the entrepreneur does exactly what you're about to do, turn around and immediately then go and raise their A, which, by the way, one of my questions is, I want to dive back to is, how do you jump in that valuation within 45 days, 60 days, where just yesterday it was worth X and now it's worth X times 5 or whatever, right? And I do know the answer, but, you know, part of what we're doing is having a conversation about that. But I'll finish my my thought there, which I totally forgot what I was saying when I went down a rabbit hole. It was magical. anyway, yeah, we what's the time?
To,
Oh, go ahead.
To answer your question, the reason to suggest a shift between one endpoint and the other is two for us. At least two come to mind. One, everybody in the bridge was strategic or follow-on investor. So it was
Fair.
all pro rata, and it was the CEO, the CEOs, like we're one of our investors who just put in 200K, recently went through a transaction where for just short of $1 billion bought a large MSP group in the Southeast.
Oh,
Like,
I like that
so
guy.
like it's strategic for us. The other part is what we've raised thus far actually doesn't put a mark on valuation. It doesn't. We have deferred valuation to this A. So you could be upset by other people
you
who
sexy
previously said
bastard. Look at you with your big
we're
old
just
brain.
now coming. We're just now coming to valuation.
So you raised everything on notes and safes, on convertibles and safes. And so there is no valuation at this point. And so this is where the magic happens, is you'll be able to roll into a Series A with no valuation ever being set. And you'll be able to point at your revenue and your track record and all of the metrics, and it'll be a fresh to the party evaluation. And that's how the actual valuation isn't taking a jump. It hasn't been set. And that's how the people who are investing on the safe notes get to experience a huge uptick.
So I will say, as a matter of practical reality, when you put a cap on a safe, you are setting a conversion point. It is around. Okay. As a matter of practical reality, the numbers all are calculated from that point. That's just how it works. But the point that we're making to anybody is just that. Like, we have not set valuation yet. We are fresh to the party. This is your chance to put in at 20x. Let's say 18x. I like that number because when we do 3x, you will only be, we hit 3x in revenues this next year. You will be trading our shares at 6x. The public markets are still 5 to 8.
Yeah.
Right. So now you're perfectly aligned with the Series B. You gave us 24 months though. So another cycle of 24 months, another 3x. Now it's just 2x our money. When I go to the Series B and I'm able to take your 2x on the valuation to revenues, right? So you valued us at 18 million and we're doing, whatever. So you didn't, I'm getting ahead of myself, but you take that mark to the Series B and they re-jump it to 12x. Your 2x to 12x is your spread.
That's nice. That's nice. Yeah. Hey, can you do a thing? What you just said was intuitively, I got it flawlessly, of course.
Perfect.
Yes. But not everyone is gifted with the gray matter that I have. What do you think that you would be able to do, like a 5-minute video explaining with graphs and stuff and dropping it into the LinkedIn group of how this mechanism of, safes versus setting the valuation versus the whole model you just walked through? Because I liked hearing you say it, but I'm very visual, and having like a slide of 2 or 3, that would be awesome.
That's Michael Scott, right? On The Office. He goes, explain it to me like I'm a 7-year-old. And they start talking. He goes, no, like I'm a 5-year-old.
That's it. I need you to use different colors and tell me which ones are good and which ones are bad, and remind me as you go.
So I think there's a lot of resources out there talking about what happens with valuations, but not how they're calculated.
Agreed.
And what that means because the accountants jump in and they start using terms like, discounted future cash flow and things like that are not helpful to practitioners who are jumping into it for the first time, to basically say, like, yeah, all you do is figure out, like, I remember it being a breakthrough for me when I realized that in like service businesses, when you value them at 3x, your basic at top line, let's say you do $1 million a year service business and it's 3x, you're basically saying, this business will continue for 3 years and give me all that same money. But I believe that I can actually grow the company while at the same time servicing the note or whatever it is to buy the company in 1.5. And I think I can double that. Therefore, boom, that's why I buy your company at 3 million, because it's not just because there's going to be a hot potato where I just kind of hold on to it, turn and flip it to the next buyer upstream. It's because I can do my magic, get my money back out of this, and then turn around and do that faster. Right? Because the point is speed. Like right now, like every company's a $1 billion company. I mean, they talk about this. Somebody was telling me years ago, over in China, they don't talk about speed in the same way we do. Now it's changing, but they think in terms of much longer periods of time. So when you start up a company in China, you're basically saying, for the rest of my life, I'll be doing this thing.
Right.
And so
that's heavy.
You're not building something for arbitrage, exit, and valuations, and figuring out who will value this thing more if you can put it together with something else. You might, the Chinese economy is flipping and growing up into more Western style, but that was not the plan. If you started a software company that solved the problem, then you were that software company from then on.
Yep. Not today, not anymore. I mean, the problems change. So building a thing that does a thing, and then the reason that thing exists goes away, seems super risky to me. But that's not. So we're coming up on our time here. They're nice, wonderful people. I think I've gotten so much wisdom just sprinkled into their brain. In summary, I believe that it's really, really fun watching you navigate how much money to raise, what does dilution mean, what is the cost of an oversubscription at an early stage, what does it look like to go and set valuation at your Series A after you have raised all of your pre-money, all the money before that on safes and convertible notes, and how do you manage all the different expectations. It is a full-time job. This is why people suffer, is that they don't understand the amount of work that goes into raising money. They think I go into the thing, I knock on a door, someone writes me a check, and I go back and run my business. But actually, that's not the case. If you're in the capital allocation game and you're taking money from outside investors, you have to play this game of, if I take this money, and then what is it going to look like, and what are my numbers and all this stuff. It's not enough just to take someone's money and build a great company. You have to take someone's money and build a company that checks the boxes for the future investors and also taking care of the past investors. And that's a full-time job.
That's right. It is a full-time job.
Yeah. Well, that's
my other stone that I'm throwing at that.
It's a full-time job. Well, yeah, man, this is good times. Again, don't fuck it up. All right.
That was the backup name for our podcast.
Yeah, don't fuck it up. That's my whenever we put so much pressure on ourselves to succeed that I'd like to poke fun at the don't fuck it up. We have to screw it up. If you don't screw it up, you got to get in the soup. So when I say that, I hope you realize, I mean, you're going to screw it up, and that's okay, but keep going. I actually told somebody that a week or two ago, and they took me serious. Like, oh, I shouldn't screw up. I'm like, oh, dude, no, you're going to. That was sarcasm. I'm so sorry. Maybe we weren't tight like that.
That's right. But whenever my wife brings me something that she's anxious about, I have a bad habit of saying like, oh my gosh, you're absolutely right. It'll never get better. It'll always be the same. And we're stuck like this. And she'll be like, I get it. We're not. It'll be fine. She hates it when I do that.
Yeah, I can't imagine why. That sounds super validating, man. So next episode of Two Stones, One Bird, how to tragically end a marriage in the middle of a startup. Zach's we are a subject matter expert.
How to start up a single life. Yes.
Are you great at business but suck at people? Hey, have you? Anyway. Okay. Well, enough of that. Peace. Hey, and thanks for joining us for the TSOB podcast. Find us on LinkedIn and give us your hot take. The whole reason we're doing this is to get access to better conversations that help us up our game. And if you have something you want to share, we want to hear about it. Find us on the TSOB LinkedIn group and jump in with 2 feet. We can't wait to chat.